Imagine you're trying to put out a massive, just a raging house fire. But you have to coordinate with like 7 different fire departments to do it.
Right, and none of them are talking to each other.
Exactly. They all speak different languages. They have completely different water pressures. And, none of them can agree on whose water is too expensive to use.
Yeah, which is a nightmare scenario.
It is. And over the next 72 hours, the global financial system is about to do exactly that. This is Gilded News, not the deep dive, and I'm your host.
Glad to be here for this one.
Yeah, so today is Monday, March 16th, 2026. And right now, we're looking at a macro environment that is just, flashing warning signs across the board.
Red lights everywhere.
Literally everywhere. And the match that started this fire is oil. In just 6 weeks, Brent crude has violently skyrocketed. We're talking going from $68 to $100 a barrel.
It's a massive move.
It is. It's this huge energy shock, and it's colliding head-on with the AI boom and, a highly fragile global financial system.
Yeah, and the thing is, when energy moves that fast, it doesn't just affect, prices at the pump. It alters the fundamental cost of capital everywhere on Earth.
Right.
Because a $100 barrel of oil bleeds into the cost of manufacturing, the cost of shipping, and ultimately it bleeds into the cost of borrowing money.
Which is everything.
Exactly. But if you watch the financial media right now, you're just getting fed these, isolated, frantic news alerts.
Yeah, just panic clicking.
Pretty much. You get a headline about a Middle East supply chain disruption over here, and then, a headline about a tech stock sell-off over there. It just creates a tremendous amount of noise.
Which is exactly why our mission for our deep dive today is to zoom out. We are turning off the television. We're looking at the structures, the calendars, and the actual public filings.
The primary sources.
Yes, the primary sources. Because when you stack these up side by side, you start to see the interconnected systems. You see the hidden leverage points that the consensus narrative just completely misses.
So let's actually start with that fire department coordination analogy, because the calendar for the next 3 days is, it's the perfect example of a structural signal hiding in plain sight.
Okay, set the stage for us.
I want you to look at a 72-hour window starting today. 7 central banks are announcing their interest rate decisions. S&P Global is officially calling this a super week.
Yeah, the super week.
Yeah, and Forex Rev actually put out a warning that this coming Thursday might be the most difficult, volatile trading day of Q1 2026.
Okay, I have to play the skeptic here for just a second. Don't central banks usually meet around the same time of the month anyway?
Well, yeah, they do.
Right, because the end of the quarter always brings this natural clumping of schedules. So isn't this just a bureaucratic coincidence?
They do cluster, yes, but this specific sequence, during an active energy crisis of this magnitude, that transforms a regular schedule into a real-time synchronized stress test. Let me break down the actual timeline. Today, Monday, March 17th, we have the Reserve Bank of Australia, the RBA. And remember, they already surprised markets with a rate hike in February.
Right, they kind of set the tone early.
Exactly. Then Tuesday is the Bank of Canada, Wednesday is the Federal Reserve, and then Thursday is the main event.
The big one.
The really big one. The Bank of Japan, the European Central Bank, the Bank of England, and the Swiss National Bank. All of them deciding within hours of each other.
Okay, looking at that lineup, I have a theory. Tell me if I'm off base here.
Let's hear it.
If we treat this like a courtroom trial, does the RBA going first act as like the opening statement?
Oh, that's a good way to look at it.
Right, because whoever speaks first essentially frames the entire trial before the Fed even has a chance to clear its throat on Wednesday.
That is exactly it. The sequencing is absolutely the signal here. The media treats these as 7 independent decisions, but in reality, this is a coordinated sequential response to one overriding question.
Which is who takes the hit.
Exactly. Who is going to absorb the economic pain of this oil shock? The banks that move first dictate the global narrative.
So the RBA today.
Right. If the RBA hikes or even just holds today, they establish a hawkish baseline. They're basically telling the world, hey, inflation from a $100 barrel of oil is a bigger threat to us than slowing economic growth.
Wow. And on the Thursday, banks are just trapped.
Exactly. The banks that go on Thursday become followers. They're forced to react to the precedent set by Australia and, obviously, the U.S.
Okay, let's talk about the U.S. then. What is the actionable intelligence for Wednesday's Fed decision? Because if the tone is already set by Australia, what are we actually looking for from Jerome Powell and the Fed?
You want to completely ignore the headline interest rate decision.
Ignore the rate. Really?
Yes, ignore it. The real data on Wednesday is inside the summary economic projections, the SEPI, and specifically the dot plot.
Okay, the dot plot.
Because with oil up 30+%, the economic models the Fed was using just 2 months ago are basically obsolete.
Just to make sure everyone listening is on the same page, the dot plot is basically this anonymous chart the Fed releases.
Yep.
Each central bank official places a literal dot on a graph, and it represents exactly where they think interest rates should be at the end of the year and, in the years following. It's like a visual heat map of their internal disagreement.
And that heat map is going to be incredibly revealing this week. If you learn the broader SEP, you really want to watch the relationship between their growth estimates and their inflation estimates.
The spread between them.
Right. If their updated GDP forecasts drop significantly while their inflation expectations rise, that is the structural signal for stagflation.
Oof, stagflation.
Yeah. It's the Fed quietly, mathematically admitting that the oil shock is choking economic growth while simultaneously driving up the cost of living.
Which brings us to Thursday, the day Forex Rev called the most dangerous trading day of the quarter. You've got the Bank of Japan, the ECB, the Bank of England, and the Swiss National Bank.
A packed day.
It's insane. And the ECB and BOE have completely different localized pressures than the Fed, right? I mean, they don't have domestic oil independence like the U.S. does.
Not at all.
So a $100 barrel hurts European heating and manufacturing structurally differently. But I really want to focus on Japan here because they seem to be the actual powder keg.
Oh, the BOJ is the ultimate wild card right now. Currently, the U.S. dollar to Japanese yen exchange rate, USDJPY, is sitting at a highly elevated 159.40.
Which is historically really high.
Extremely high. If the Bank of Japan delivers a hawkish signal to protect their currency from this imported oil-driven inflation, it threatens to push that exchange rate sharply below 155.
Okay, and why does that 155 level matter so much?
Because if that happens, it completely dismantles the yen carry trade.
Okay, let's break down the mechanics of the carry trade for anyone who, doesn't spend their days staring at Forex terminals.
What I do?
The carry trade is basically borrowing money in Japan, where interest rates have historically been zero or like incredibly close to zero. You take that deeply cheap borrowed yen, you convert it, and you buy high-yielding assets in the U.S.
Right, like treasury bonds or big tech stocks.
Exactly. And you just pocket the difference in the interest rates. That's free money, right?
It is, and it's basically the fundamental plumbing of global liquidity. But, and this is a huge but,
Yep.
it only works if the Japanese yen stays cheap and stable.
Oh, so if the BOJ hikes rates.
If they suddenly hike rates on Thursday, that borrowed yen becomes much more expensive to pay back. Institutional investors start facing massive margin calls.
Because the math flips on them overnight.
Exactly. To cover their suddenly expensive Japanese debts, they are forced to aggressively sell off their global assets. Those U.S. treasuries, those tech stocks.
They just dump them.
Yeah. It triggers a massive synchronized tightening of global liquidity, all because one central bank in Asia had to react to a Middle Eastern oil shock.
It's just wild how interconnected it all is. That dynamic, a central bank quietly pulling the strings of global liquidity while the media focuses entirely on headline rates, is exactly what we're seeing in the technology sector right now, too.
Oh, absolutely.
Only instead of monetary policy, it's a quiet regulatory filing.
You're talking about the Bureau of Industry and Security.
Yes. Let's look at this bizarre Vanishing Act, because this blew my mind when I saw it.
That's a crazy story.
On February 26th, the new export rule quietly appeared on a relatively obscure government website called the Office of Information and Regulatory Affairs, or OIRA. The title of the rule was AI Action Plan Implementation.
Sounds pretty standard.
Right, sounds like basic bureaucracy. But 15 days later, on Friday, March 13th, the rule was withdrawn. It just vanished.
Poof, gone.
Gone. No press conference, no official explanation. The only reason we even know it existed is because reporters at Reuters and Bloomberg were actively monitoring the site.
And the details of this filing, it's logged as RIN 0694AJ90, by the way, show that this was not a minor administrative tweak.
Not at all.
According to Tom's Hardware and Bloomberg, this rule would have required U.S. government approval for virtually every artificial intelligence shipment globally.
Wait, globally?
Globally, not just restrictions on China, everywhere.
The scale of this is wild. I mean, if you were shipping a small batch, say under 1,000 Nvidia GB300 GPUs, you'd go through a simplified review process.
Right, a fast track.
But for massive clusters, anything over 200,000 GPUs, That would require direct government-to-government negotiations.
And we really need to understand why that 200,000 number is so critical.
Yeah, contextualize that for us.
A 200,000 GPU cluster isn't for some random Silicon Valley startup. That is the foundational infrastructure scale required to run an AWS data center,
Wow.
or Microsoft Azure, or, the next iteration of OpenAI.
The big boys.
Exactly. If this rule went through, the U.S. government would effectively hold legal veto power over who gets to build foundational AI infrastructure anywhere on the planet.
I have to formulate a hypothesis here because the timeline is just deeply suspicious.
It really is.
You don't draft a sweeping global regulatory net, submit it to OIRA, coordinate the Commerce Department, the Defense Department, and the State Department, and then pull it back in 15 days just because somebody found a typo.
No, absolutely not.
Right. If it's not a bureaucratic mistake, it has to be a flex. You're trying to send a message to someone very specific.
And if you look at the calendar, you get your answer.
Yeah.
2 days after the withdrawal, Sunday, March 15th.
Nvidia's massive GTC keynote.
Exactly. Jensen Huang walked out on stage, and his core pitch was explicitly targeted at sovereign nations.
Right, I remember that.
He was telling foreign governments that they cannot rely on Western tech monopolies. They need to build their own domestic sovereign AI infrastructure.
Oh, wow. You cannot sell sovereign AI to a foreign government if Washington retains a kill switch over every single hardware purchase.
We just can't.
I mean, no country in Europe or the Middle East is going to invest tens of billions of dollars into a national data center if the U.S. Commerce Department can just halt the chip supply on a whim.
Exactly. The regulatory sequence was a choreographed negotiation tactic.
The stick and the carrot.
Precisely. The administration put the OIRA filing up to show global players the stick. They demonstrated exactly what maximum restriction looks like, basically saying, we have the bureaucratic architecture ready to lock down the entire global supply chain.
And then they pull it.
Then, 48 hours before the biggest AI sales pitch of the year, they withdraw it. They show the carrot. They signal a willingness to allow this sovereign AI build-out to proceed, provided these nations play ball with broader U.S. strategic interests.
Wow. Though it is highly notable that the existing heavy restrictions on China remain fully in place.
Oh yeah, those aren't going anywhere.
Right. The global net vanishes, but the targeted wall stays up. Now, for you listening, if you want to verify this timeline, we actually posted the direct OIRA filing link at Real Gilded News on X. You can check the paper trail yourself.
It's a public record.
It is.
Yeah.
So what is the actionable intelligence for someone trying to navigate this AI space right now?
First, bookmark that OIRA page for RIN 0694AJ9 dear. If it reappears, or if you start seeing the phrase AI diffusion in future Commerce Department rulemaking, you will know the administration is bringing the stick back out.
Okay. AI diffusion. Watch for that phrase.
Second, for Nvidia investors, the key metric to track is whether this new sovereign AI demand that Huang is pitching can actually replace the massive revenue hole left by the China restrictions.
Right, because that hole is huge.
It is. The withdrawal gives them a runway to sell, but the geopolitical math still has to add up on the balance sheet.
It is amazing how easily structural realities get buried when you're distracted by loud narratives. I mean, the financial media was so hyper-focused on the oil shock and the AI keynote that they completely missed a global regulatory framework appearing and disappearing.
They completely missed it.
And that exact same dynamic, missing the signal because of the noise, brings us to the biggest economic data drop of the weekend.
Yeah, let's talk about China. Because China's National Bureau of Statistics quietly released their combined January and February economic data over the weekend.
See, my consensus view going into this weekend was that China's economy was fundamentally stalling out.
That's what everyone thinks.
Right. Everything you read in the Western financial press is about deflation, a massive unresolvable property crisis, and, a terrified consumer base. CNBC even ran a report recently stating their 2026 GDP target was lowered to the weakest level since the 1990s.
That is absolutely the dominant narrative. But the actual hard data, which the South China Morning Post noted, was collected before this recent oil shock hit, paints a completely different picture.
Okay, let's hear the numbers.
Let's look at them. Industrial output hit 6.3%, easily beating the 5.0% estimate.
Wow, okay.
Retail sales hit 2.8%, beating the 2.5% estimate. And keep in mind, that is a massive acceleration from December's anemic 0.9%.
Those are solid beats, definitely. But the number that really jumps off the page to me is fixed asset investment.
Yes, this is the big one.
Analysts were expecting a negative 2.1% contraction. Instead, fixed asset investment hit a positive 1.8%.
A massive swing.
How are they swinging a 4-point beat on hard assets like factories, machinery, infrastructure, when their real estate market is notoriously collapsing?
Because this exposes the core mechanism of how a centrally planned economy manages a crisis. Beijing is forcibly redirecting capital.
Just moving the money around.
Exactly. They are taking the credit that used to flow into property development and aggressively injecting it directly into advanced manufacturing, green energy, EVs, and solar infrastructure.
Oh, wow.
They are building industrial capacity at a staggering rate to offset the real estate drag.
But if they are aggressively deploying capital into manufacturing right under our noses, why is nobody talking about this? Why did this data get buried on, like, page 12 of the financial papers?
Because the weak China narrative is incredibly sticky. It is emotionally satisfying for Western capitals.
Emotionally satisfying. How so?
Think about it. If you are a policymaker sitting in London or Washington, dealing with a brutal energy shock and sticky domestic inflation, it feels comforting to believe that your primary economic competitor is collapsing.
Oh, it's copium.
Exactly. That narrative supports the case for continued U.S. dollar strength and props up the idea of Western economic exceptionalism. But the hard data proves that China entered this current global crisis with far more industrial momentum than the stale 2024 narrative suggests.
So how do we verify if this is a genuine structural acceleration or just, temporary noise from the Lunar New Year holiday? What's the actionable intelligence here?
The immediate tell will be the People's Bank of China, the PBOC. They announced their loan prime rate decision on Friday, March 20th.
Okay, watch the PBOC.
Right. If they cut rates, they are essentially flashing a red light to the globe, signaling that Beijing views the new oil shock as a severe threat despite these strong Jan-Feb numbers.
If they don't cut.
If they hold rates steady, it means they feel confident that this underlying manufacturing momentum can absorb the $100 oil.
Interesting. And beyond the central bank, how do we track the physical economy? You mentioned to me earlier tracking the Li Keqiang index. For listeners who haven't encountered that term, what is it?
The Li Keqiang index is an alternative economic measurement. Historically, official Chinese GDP numbers were often viewed skeptically by analysts.
Right. People thought they were cooked.
Exactly. So this index relies instead on hard physical data that is much, much harder to manipulate. We're talking about things like railway freight volumes, industrial electricity consumption, and bank loan disbursements.
You can't fake train cars moving.
Exactly. If the Li Keqiang index components rise alongside this official data, it verifies that the factories are actually running hot.
And if those factors are running hot, the implications for commodity investors are massive.
Huge.
Because if China is building fixed assets at a positive 1.8% rate instead of contracting, they are buying raw metal. That establishes a massive demand floor for iron ore and copper that the current market narrative simply is not pricing in.
We really have to pull all these threads together because this is how you read the structures instead of just reading the headlines. We started by looking at a synchronized global stress test. 7 central banks in 72 hours, all answering the exact same question of how to absorb a violent oil shock.
Right, the RBA setting the baseline today.
The Fed revealing the structural damage to growth on Wednesday, and the BOJ potentially unwinding global liquidity on Thursday.
Then we followed the paper trail to uncover a choreographed geopolitical negotiation, an AI export rule that appeared for exactly 15 days, threatening a global supply chain veto, only to vanish 48 hours before the industry's biggest keynote.
Incredible timing. And finally, we looked at the buried data. China quietly beating every single economic estimate across industrial output and fixed asset investment.
By forcibly pivoting capital into manufacturing.
Right, which completely shatters the comforting Western narrative that their economy is paralyzed.
If China is quietly cornering the market on industrial metals to build out this massive fixed asset infrastructure, and the U.S. is weaponizing the regulatory bureaucracy to maintain global supremacy over AI chips, it brings up a fascinating structural question.
What's that?
When the dust finally settles on this $100 oil shock, will we still have one integrated global economy? Or are we watching the final days of globalization as we know it, fracturing into a hard asset Eastern Bloc and a tech monopoly Western Bloc?
See, that is the structural reality hiding behind the isolated headlines. That's what you have to chew on.
And speaking of this week, we are just getting started. Tomorrow, the Federal Reserve officially begins its 2-day meeting, Wednesday's show of Gilded News will break down the Fed's actual SCMP projections and set the stage for Thursday's unprecedented quadruple central bank day.
It's going to be a wild Thursday.
The Bank of Japan, the ECB, the Bank of England, and the Swiss National Bank all deciding within hours of each other. 4 central banks, one day during an active energy crisis.
Yeah.
You won't want to miss it.
Absolutely not.
Follow Gilded News on X at Real Gilded News for daily clips, links to all the original filings like the OIRA document we discussed today, and the stories behind the stories. We'll see you on Wednesday.